Welcome to Kaiser Watch with John Kaiser. I'm your host, Jim Goddard. John, what's coming up on the show today?
Well, the third quarter of 2024 just ended, and we're going to talk about how my KRO Favorites Collection for 2024 has fared so far this year and what we might still hope for before the year is at an end.
How have the 2024 KRO Favorites done at the end of the third quarter?
Well, as a group, the 10 companies of the 2024 Favorites Collection are down 15.9% as of September 30th. The highest it was up was 10.5% on May 17th, and the lowest was down 22.3% on September 10th. During that same period, gold is up 26.5%, while the TSX index is up 5.1%. It is a truly dismal performance in both absolute and relative terms, and it really causes me to think, why am I doing this? Why do I do this weekly or bi-weekly Kaiser Favorites commentary? Well, when we go through the what's left in the index and what still is there and why it's down, there's still good reason to continue to do this.
What's dragged down your KRO Favorites collection this year?
The big disaster has been loading it with 3 lithium juniors. They're 30% of the index. Brunswick Exploration Inc. is the worst, down 77.7%, followed by Patriot Battery Metals Corp. Down 58%, and ASX-listed Winsome Resources down 45.7%. Their flagship projects are all in the James Bay region of Quebec, and the problem is the price of lithium carbonate and spodumene concentrate is half of what is needed, not just to deliver the lithium needed to meet net zero emission goals by 2030, but even to keep hard rock spodumene mines or pegmatite deposits operating that are currently in production. So basically the pricing the rug was pulled out from underneath this sector, and it is across the board. Lithium juniors have done terrible. And the sentiment is in no danger of turning positive. We won't know the future for the energy transition until after the election, but we may not know what the election outcome is until 2025. In last night's debate, Shady JD pretty much confirmed that any election that isn't a victory for the Republicans is a stolen election, and they will do their best to prevent a certification of Harris as the new president. And of course, Trump is on record as declaring that climate change is a hoax, and he isn't even sophisticated about in what aspect it is a hoax. And his groveling support for the fossil fuel sector pretty much guarantees that if he ends up in charge, he will do everything he can to reverse energy transition policy. And with regard to the EV sectors, for which the lithium is destined, it's in a slump anyways right now because the Western car makers haven't delivered a car cheap and good enough for mass adoption. The Chinese have delivered one that's cheap and good enough given the cheapness for mass adoption, but the Western car maker or Western nations do not want their domestic car makers destroyed by an influx of cheap Chinese exports, so big tariffs have been erected. So the whole sector is in a bit of an hiatus, waiting for the solid-state innovation that finally delivers a car that does what the consumer wants it to do. So as far as this group is concerned, it's not going to bail out the Kaiser Favorites Index before the end of the year. In fact, there'll probably be a horrific tax loss selling season in December, which could prove to be a wonderful bottom fishing opportunity, especially if there are signs that the Democrats will prevail and that they will keep the energy transition goals going. Now, Brunswick is still an exploration junior and has yet to deliver any game-changing results this year. They started a 5,000-meter summer drill program at Mirage, but from the description of its scope, I don't see that there's any really significant step-out hole potential that could make this the Mirage pegmatites bigger and better than what we learned they were at the end of the winter drill season. Brunswick has chewed through $1.8 million in overhead during the first 6 months of this year, of which nearly $500,000 was for investors' relations. This has been an awful year for the resource juniors. How can you waste $500,000 flogging a lithium story in a market that is bad in general, but in particularly hostile towards the lithium sector? So for Brunswick, brace yourself for a big dilutionary flow-through financing at the end of the year to replenish their treasury, or as I suspect, there's going to be a roll-up involving a bunch of James Bay Lithium juniors with probably rollback haircuts for every one of those companies involved. Now, both Patriot Battery Metals and Winsome Resources have delivered PEA-level economic studies for Jackie Chu and Adina, whose NPV and internal rates of returns, IRRs, clear development hurdles. But unfortunately, they did that with spodumene concentrate prices that are double the current spot reality. So the market has shrugged, we're not sure that the energy transition is going to actually be a policy that the world pursues. So both stocks have slumped and are in no danger of heading higher until there is signs that indeed the energy transition effort is still on track.
How have your non-gold exploration juniors done?
The three non-gold exploration juniors in the favorites are Canalaska Uranium for uranium, of course, as the name indicates, Hercules Metals Corp for copper, and PJX Resources for zinc, lead, silver. Now, Canalaska is only down 8.1%, and it has delivered the most promising drill results of these three juniors this year. The focus has been on the Pike Zone within a graphitic peelite corridor at the unconformity between the sandstone of the Athabasca Basin and the basement rock. Now, that's geology talk, which tells you that they're looking for a MacArthur clone, because this is exactly the geological environment where these very rich 10 to 20% or even higher U3O8 deposits form. Now, I adopted them earlier this year, not at the beginning, as a favorite when they finally hit the Pike Zone at the unconformity with high-grade mineralization. And for most of the year, they have been drilling within almost like a slice of this corridor, probing where it all goes, but not stepping out too much. And the stock has kind of stalled, and we're starting to get worried in September, because in July, they gave us, results based on radiometric readings. The way it works, they pull the core out, put it in the box, drop a probe down the hole, and measure what basically the geochemical assay will roughly be when they finally receive those 2 to 3 months down the road. And the company had developed a policy of, when we get good results, we'll measure them and we'll report them so the market can track how this discovery is taking shape in the third dimension. So suddenly having a couple of months of silence was not a good sign. And then we got a couple of weeks ago, we got another hole from that initial section across the corridor with more assays. But then the question was, wow, is this all they have after several months of drilling? Obviously, they're not hitting anything else along strike. But then a week ago, they put out a batch of 4 holes, which are 100 meters to the southwest of the initial Pike slice of the corridor. And yes, it also has enriched uranium mineralization up to 22%. And now the question is, okay, 100 meters, that's a significant strike. Now, when you look at the drill plan, you see 3 red stars there indicating older holes, and it looks like they did intersect that corridor. But what we don't know is if they pretty much hit it too deep and did not hit the unconformity, because it's clear that the mineralization is richest at the unconformity. When you follow the structure down plunge, it doesn't always continue to have the good mineralization. But now at least we have two segments of this corridor that are uranium enriched, and the company can continue to drill. If it can stitch these together over the next 3 months and demonstrate that there is enriched uranium mineralization all along it, then we are on track to saying this is a MacArthur clone, a world-class MacArthur clone beginning to take shape before us. And the thing they did, when you look at these 4 holes, well, these 4 holes probably took 6 weeks to drill. So they've been sitting in the box. Some of them have been sitting in the box for some time, and they've been sitting on these radiometric assays. So clearly they've changed the strategy of real-time EU308 reporting of the results. And that's probably a good thing, because you do a step out and you get one slice. Yeah, everybody's excited, it looks great, but then you do more step outs and, well, it's not quite there. Which way do we go? And then suddenly the silence makes everybody say, okay, I guess it's just this little tiny thing that we have. But by batching it so that when they publish them, you can see some sort of 3D volume emerge, that's probably a good idea. So I'm optimistic that Canalaska Uranium, by the end of this year, can put enough evidence on the table that it soars through $1 and becomes celebrated as the next big MacArthur-style discovery. Now, Hercules Metals Corp, it's down 23.5%, and it wasn't in my favorites collection at the start of the year because the stock was over $1. It was, pretty more than fairly priced. But then they put out the final results for last year, and the stock tanked down to 80 cents. And I said, okay, this is a more reasonable price. They got a $23 million in the treasury. They got a big program going. This is going to be a year of results flowing continuously, giving shape to an underground mineable copper-enriched system in Idaho. But the reality has been they've only drilled 4,600 meters in 6 completed holes as of July 31st. They've encountered very difficult drilling conditions. The rocks are all faulted, difficult to drill through, and we still don't even have any assays yet. And yes, it's the beginning of October, and drilling started at the beginning of May. In fact, in September, they decided to add an RC rig to see if progress can be sped up. And the other thing that's the reason the stock is down 23.5% is the market's starting to think they're not really figuring out the geology. They do not know what controls the mineralization that's rich enough to be underground mineable. And you read the geotalk in the press releases, and yes, they're still trying to sort it out. And even worse, I'm beginning to worry that this Diaz IP geophysical survey that they have used to show them where the system is, it may be doing a little bit of a variation of AI hallucination. And we saw something like that in one of my bottom fish, Santa Tana Resources, which I wrote up. I liked the story. I didn't make it public to the favorites. It was for my paying clients only, and the stock's pretty much sort of where it started. But they had similar type of anomalies, and when they poked holes into those deep anomalies at 400-meter depth, well, there was nothing there to explain it. So they were mirage. So these IP surveys, they may not be, even with this particular type that proved successful in the beginning with Hercules, they may not be the key to sorting out. It's going to be just brute force drilling, and if the nature of the rock restricts that, it's going to be a long time before you have it figured out. But the slow pace of work has left Hercules with still about $20 million working capital in the treasury as of June 30th. And so if we have an end-of-season slump, it's not going to hurt the company in terms of, we need to finance at rock bottom prices. But, there are still assays pending, and they are still drilling holes. So Hercules could also still help bail out my index by the end of the year. Now, PGX Resources, it did not start drilling until the second week of August, and it did provide an update on September 5th, to which I devoted part of a Kaiser Watch episode to. But the bad news of that was the initial holes that they drilled from a pad whose location wasn't exactly ideal. The best that those intersected was pyrrhotite of the kind that you find in the vent base of the Sullivan deposit. They have not yet, or at least haven't reported yet, intersecting the zinc galena enriched massive sulfides that's in the boulders that are in the talus pile at the base of the mountain. So the problem with PJX is CEO John Keating is great at promoting the story when he's not in a position to change the information about the project. But as soon as he starts a drill program, he kind of pulls a cone of silence over everything and leaves the market hanging there wondering, well, when are we going to get assays? Is it going to be like news? Yeah, we've got like 6 studs drilled. We have no idea where this thing is. Or are we suddenly going to see a discovery holes? So volume has dried up. There is a big flow-through overhang from last October, November's financing that needs to be liquidated for structural reason probably by the end of October. So the market has taken a glass half empty view to this play, and nobody's in a particular urge to gamble. We know that if they put out some encouraging news, that's, they finally found the enriched horizon, and now it's going to be just a task of chasing it where it goes. There will be just a big pile of flow-through paper coming into the market. So this one could still bail me out, but I'm not in a hurry to buy this until I see something happening showing that they're starting to figure out where the stratigraphic horizon is located within that mountain.
What about your 2 gold exploration juniors, Arizona Gold and Solitario?
Arizona Gold and Silver is down 23.9%, thanks largely to the extraordinary sluggishness of the BLM permitting system. They did not get the BLM permits for the Philadelphia project until early July. And the reason they needed the permits is because on the patented claims where they don't need these permits, they've pretty much chased the high-grade vein as deep as they can. And they need to step to the east and drill angled holes which can chase the high-grade vein down plunge. And they need to do that because they need to make it big enough to justify developing it as an underground mine. But the other key aspect is from drilling that they did earlier, there appears to be a disseminated gold system within the footwall, or not the footwall, the hanging wall of this vein. And they haven't been able to drill through that from the patented claims, but now where these 2 drill pads are located, the holes that angle towards the deeper extension of the vein will pass through this rock, and tell us if they also have a multi-million ounce bulk tonnage system, not just a 500,000 to 1 million ounce high-grade underground mineable system. Now, the bad news, the reason the stock has traded in the low 30s, is that as soon as they had the drill permit, the temperature went through the roof to levels that are lethal. If you're sitting there with a drill rig, sucking back as much water as you can, but you've got 120-degree weather, it's just too dangerous. So Greg Hahn said, we are not drilling under conditions like this, and these high temperatures have persisted. I mean, even today, here in the East Bay, it's 105 degrees. I mean, it's insane. It's early October, and it's 105. So a couple of weeks ago, Arizona Gold bit the bullet, announced 10 million unit financing at 30 cents to raise 3 million, 40 cent full warrant for 3 years. And on September 30th, they boosted that to $4.6 million. And this will probably, when you upsize it, it usually means it's going to close very soon. So at least as a result of this, they now have people on board who see the value of this story, who see that all the permitting risk has been eliminated. We know that eventually the temperature will subside even in Arizona. We're already in autumn. Winter's coming soon. And the beauty of this play is they can drill year-round. It's not like, say, PJX, where as soon as November hits, they're not going to be up on that mountain there where the snow is, piling up. They're going to have to shut down from November until May of next year. So I'm optimistic that by the end of the year, Arizona Gold could have intersections of the hanging wall that show, yes, this bulk tonnage Red Hill hypothesis is valid, and all you need to do is keep drilling holes and flesh it out. And we probably won't have those assays until November, December, assuming that sometime in the next couple of weeks of October, they do get around to drilling. Now, Solitario, I talked about extensively last week. It's up 21.1%. It's been sort of a consistent in-the-money performer all year. And they are now drilling the Golden Crest project. I refer everybody to last week's episode where I talk about the initial three holes in the downpour target. The market right now has sort of cooled on the idea because they drilled into the area, the downpour target, with the best surface gold values. They're now in the western part of the project. In the downpour area, yes, they got laterally mineralized zones, but they didn't intersect anything that might qualify as a feeder structure to help them understand, okay, what is the pathway that this gold ended up at surface to, create these wonderful, wonderful surface values. Now they're in the western part where the surface values for gold are not that interesting, but they do have elevated arsenic and antimony values, pathfinders. There's others like thallium in there too. So they are now drilling these blind pathfinder-indicated geochemical targets, and they're going all the way down to the basement rocks, the Proterozoic basement rocks that host the original homestay. And again, these are geology scout holes. They're trying to understand how does the stratigraphy behave in the area. They're hoping to get lucky and find some cross-cutting structure along which the fluids path, and then it bleeds out sideways into the better stratigraphic horizons, and then be able to continue there. So they'll have about a dozen holes done by the end of November. And the markets, because this is micron-sized gold and the stratigraphic package appears to be oxidized all the way to the basement, they're not going to see any gold potential in the box. They're not going to see sulfides or anything. So you have to wait for assays. So we could get surprise. We didn't get a monster surprise with the most obvious target with the first batch, which is why the market after the initial pickup then sagged. But this play, if they do get their Ponderosa plan of operations to allow a summer drill program next year, that's in an area to the east where the values on surface are phenomenal. If this thing doesn't take off, in the meantime, it's going to be one of the best stocks to accumulate for next year. However, be aware that in November, we may hear that Nexa is finally going to do a serious drill program on the more outlying targets at the Flora, the Canyon, zinc, lead, silver deposit project in Peru. So that could get Solitario Resources Corp going before the end of the year, even without barn burner results coming from its maiden Golden Crest drill program.
How have your advanced gold junior favorites Vista Gold and Westfault done?
These two companies are probably right now the safest stocks amongst the favorites for speculators to buy because they're not really doing anything on the fundamental side to change their intrinsic value. Both of these are permitted gold projects, shovel-ready. In the case of Westfault, it's a smaller scale operation, would produce about 70,000 ounces a year. In the case of Vista Gold, Mount Todd would produce 500,000 ounces per day. So Westfault's up 9.5%, and Vista Gold, which is the most recent addition to the Favorites Collection, is up 46.4%. That makes it the best performer. Now, obviously, I've shown the DCF calculations at the current gold price at crazy prices like $3,000, $4,000, and you can see that this stock is severely undervalued. So the fact that it's so undervalued tells you that the market does not believe the current gold price. It doesn't think it's going to be here to stay. Or if it does, it means inflation is going to surge back 10, 20% and crank up the OPEX and CAPEX so that the profits, the cash flow that's implied by the current price and recent economic studies done by both companies, all that gets swallowed up, and we're back to square one with a marginal deposit. The company put out a press release about a week ago, which initially troubled me. They've been doing some drilling on what they call the South Cross Lode Zone, and this is an area in the northern part of the whole Batman system. The Batman system itself is a sheeted vein system of fairly low-grade, closely spaced mineralized gold veins, but in the South Cross Lode area, the veins are thicker and more widely spaced. So the drilling that they are doing is designed to better quantify what is going to be the average grade potential of this area. And they have now concluded that, yes, this is a distinctly different mineralizing event from the main Batman zone. So that's good. That helps them think about perhaps the future underground potential in that particular area. But what troubled me was talk in that same press release that they are now looking at a potentially smaller scale operation. So they're doing all the scoping work for that to set the stage for possibly doing a feasibility study, basically cost discovery for an operation that instead of 50,000 tons per day, $1 billion plus capex, only 12 to 15,000 tons per day with a $400 million capex. And that scenario would probably churn out 150 to 200,000 ounces per year versus the 500,000 ounces that the full-blown 50,000 ton per day feasibility study based scenario would deliver. Now, they've been in Beaver Creek. They were in Beaver Creek doing these where you do a 15-minute presentation and then all these qualified investors sign up for 25-minute, basically a personal Q&A. And they had more than 36 such meetings, a quarter of which were corporate entities. And I don't think the corporate entities were like all the major producers that are producing 500,000 ounces or more per year. I think this included a lot of the intermediates, which are ones that produce between 100 to 500,000 ounces per year. And the message that they seem to have absorbed is that the really big majors, they're not yet in the mood to acquire undeveloped deposits with $1 billion capex that are in this less than 1 gram per ton range. The major producers have only increased 40 to 60% from their February lows. The intermediates, they've increased 60 to 120% from their lows, and they are in a better position to use their paper to acquire projects that are worth developing. But they would have a hard time explaining to their shareholders why they're acquiring a project with $1 billion capex. Now, the other problem for companies like Vista Gold is that they have just $100 million valuation. And for this thing to be in the money, you need the NPV to match the capex. So, and this actually is the case at $2,600 gold, but you now have this problem where how does anybody justify taking an 80-cent stock and paying $10 for it overnight? So there's kind of this catch-22 situation for these stocks, and this is why stocks like Vista Gold are up on days even when gold's down $25, so all the big intermediates and majors get slammed for the day by the traders. Investors out there are starting to understand that if this $2,600 plus gold sticks, we are going to see a major repricing of juniors like Vista Gold. And the rationale behind quantifying what it would cost to build a much smaller scale, lower capex deposit is to broaden the pool of potential acquisitors and to move forward when this would happen. So by doing this, the intermediates could end up making an offer. And when the market sees that we're not going to have to wait for this market to be like full-blown bull market before the majors move to acquire Vista Gold and develop Mount Todd, you're going to see that the majors right now are actually just looking at acquiring the intermediates. I mean, one of them, Newmont, one of them is acquiring Centamin, an intermediate producers, and the intermediates are sort of, well, we don't want to be swallowed by these big plotting majors. Just when we're at the cusp of a gold bull market that hasn't even really reflected in our prices what $2,600 gold means. So they're going to look at these undeveloped deposits that are pretty shovel ready, maybe take another year to tweak them to make them to the intermediate producers' liking. So this means, of course, going from 80 cents, we're talking to like a $3 to $5 price buyout with $400 million capex and an NPV that matches that. But that's a five-bagger from current levels. And if this unfolds in the next 6 months, that's still at the beginning of a major bull cycle, because then the intermediates, they will far outperform the majors, especially if they manage to scoop something like Mount Todd, which really, really works at 2,600, and even better at 3,000 to 4,000, where it isn't that hard to imagine that $3,000 to $4,000 might become the new reality. So I think Vista Gold right now is an excellent position to catch a wave and reprice into that $1.50 to $2 level. Westfall will be a little slower because it's a smaller scale system, and it's not clear yet when an intermediate will want to acquire that, because it might want to acquire others in the area. It will be slower to evolve, but if Vista Gold starts going, we'll also start seeing Westfall following behind.
What about Colonial Coal, your star favorite for most of the year?
Yes, Colonial Coal International Corp has been consistently the biggest performer in my 2024 collection. On July 31st, it hit $3.47, and it was up 86%. But after that, it abruptly developed a downtrend that bottomed at 211 on September 27th, and it was close to the low of late June. It has since bounced back a bit, where it's up 28.4%. And the story has been that this year, finally, Colonial Coal is going to attract a buyout for its Huguenot and flatbed metallurgical coal deposits in northeastern British Columbia, which have been taken to a PEA level in terms of economic studies and in quantification of what it costs to build them. And the stock developed an uptrend earlier this year when they retained Citibank to manage the bidding system for like all these different groups to go into the data room and negotiate a potential buyout. And speculation that something like that might happen imminently, that had helped drive to the stock to a high of 347. CEO Dave Austin says, a buyout in the $5 to $10 range is plausible given the NPV of these metallurgical coal assets. And because the potential bidders are all in the steelmaking business, they're not just buying this to make some sort of profit. They would be doing this to secure a long-term supply of the metallurgical coal, the coking coal that they need for their steel operations. So this is strategically guided bidding with a variety of Asian steelmakers. Things got complicated this year when on April 25th, BHP launched a hostile takeover bid for Anglo American, initially pricing it at $39 billion, eventually boosting it to $49 billion. But the South African government was not very excited about this, and BHP dropped out on May 29th. But in the aftermath, Anglo American said, well, we need to restructure ourselves. We need to spin out the platinum group operations. We need to sell our coal operations. We need to get rid of our diamond stake and just become a copper type producer out there competing with the BHPs. And what BHP really wanted was to beef up its own copper capacity by absorbing Anglo's copper capacity. So one of the first things that the Anglo-American did was say, we're going to sell all our coal assets. And there's about 5 coal mines in Australia. Most of them are metallurgical type. And they initiated a bidding system. But that got complicated because on June 29th, one of those mines, the Grosvenor, it caught fire and basically was compromised as a mine. And the market or the potential bidders realized, included in the operating are all of Anglo-Americans' coal assets in northeastern BC, which largely surround the Colonial Coal, Huguenot, and flatbed deposits. And so when they realized that this thing was going to drag out longer than expected, originally they thought the bids would be received in early September, then that was postponed to September 26th, and now they're expecting that the binding final bids will be received or in place to choose amongst by mid-November. And the market has been saying, well, whoever acquires these assets is probably going to want to dump the northeastern BC assets. So that meant, well, let's wait and see what becomes available. And so whether or not the steelmakers were actually thinking that, I don't know. But I think the market realized that the urgency to do a buyout deal for Colonial Gold, it diminished. And so the stock has been in a retreat. But I suspect that will soon retreat because the Anglo-American has already culled the list of bidders, gotten rid of all the smaller ones, and reduced it to 5 or 6 that sees as qualified to acquire these assets. And one of these is Glencore, and Glencore has a large land position in northeastern BC. It recently bought the Elk Valley metallurgical coal assets from Teck, and the Canadian government approved it. In late 2022, the government rejected its application to develop the Sukunka deposit in that area, and it was going to unload its coal assets, but its shareholders said, no, you're going to keep your coal assets, which are both thermal and metallurgical. So Glencore is staying in the coal business and is a major bidder for the Anglo-American assets. And if they do include the assets in northeastern BC, I don't think Glencore, if it wins this bidding process, is going to unload them on somebody else. So all these other potential bidders who are hoping to pick up these scraps are now rethinking what's going on, and the sort of recent rebound from the low reflects the realization that we now finally see what the timeline is going to be for Anglo unloading its coal assets. And we can also see that there will not be any scraps available for those who weren't entitled to bid in the first place. So it's potentially game on again for Colonial Coal, and we may see a buyout offer by the end of the year that helps drag the KRO Favorites Index back into the money so that it doesn't have to close the year with a negative return.
John, thank you so much for the update.
You're welcome, Jim.
We've been speaking with John Kaiser. I'm Jim Goddard. Comments made on Kaiser Watch are an expression of opinion only and should not be construed in any manner whatsoever as a recommendation to buy or sell any financial instrument at any time. Archived online at kaiserresearch.com.